The Federal Reserve just cut interest rates by a quarter of a percentage point, which is the third cut this year. So this is a slow, gradual easing trend and not a big emergency slash of rates. But here's where it gets interesting. The vote inside the Fed was split. One member wanted a bigger half percentage cut, and two members didn't want cuts at all. This is the biggest disagreement we've seen inside the Fed in years. So what does this mean for you and mortgages? First, mortgage rates do not move in a straight line with the Fed rate. They follow what investors expect for inflation and the broader economy, not just what the Fed does at any one meeting. Because this cut was widely expected, a lot of it was already priced into the bond market. That means that mortgage rates may not drop overnight just because the Fed moved by a quarter point. In fact, some recent court cuts, mortgage rates have actually stayed flat or even ticked up a bit as the markets react to the Fed's comments, not just the headline. Second, the outlook the Fed gave for 2026 matters. Right now, they're only projecting one more small cut next year, and some members are still arguing for more cuts or even a possible hike. That tells you that the Fed is not convinced that inflation is fully tamed. This means you will likely see windows of opportunity where rates dip and then bounce rather than one small decline.